how developers get paid. There are a couple there that you will not have thought of. You'll be blown away. So stick around for that one or two, and we'll go from there. Right, so the first one, the obvious one, is development profit. A developer finds a site, builds it, delivers it, sells it to the end user. Let's say they buy a house, build a house for £200,000. They bought the land for £50,000. All the other costs, financing, professional fees, came to £50,000. So the total cost to the developer is £300,000, and then they sell it for £500,000. There's a £200,000 profit. Perfect. That is the obvious way. Developers put together this deal, put a team together, delivered it, sold it to an end buyer, and have made a £200,000 profit. That is obviously the way to do a deal. They've added value, they got planning, they did the build, they sold the unit at the end, they exited, they profited. It's a one-off payday. It can be considered somewhat high risk, because if that doesn't go to plan and that's the only way they've figured out they can make some money, that could be quite dangerous. What if the market turns, the seller pulls out, there's a major issue during construction, then you're waiting, could be well over a year before you get any money out of the deal. This is why I don't quite like that method of just relying on that element, although 9 times out of 10, that's where the biggest money to be made is as a developer at the end. But you have to structure this in a smart way. But it does work. Not all developers need the money straight away, and if you're very liquid, you're happy to wait. That's fine. Another way is at the end of this housing development, let's say you, instead of selling it, it costs you £300,000 to deliver the whole thing and buy it. It's worth £500,000. You then go to a bank and get a loan of 80% loan to value, i.e. 80% of £500,000 is £400,000. And so on day one, once you refinance, you're going to have the £400,000 minus the £300,000 that you spent. You're going to be left with £100,000 on day one. And then the equity you have left, because it's 80% loan to value, will be £100,000. So you may be very happy with that. You may be happy to do a development, hold it. You've got £100,000 of equity. You took £100,000 cash out and you got your £300,000 back. That's the refinance method. Put it on an investment loan. So that's another way a developer gets paid. It's great if you want to hold the asset, and then obviously once you've rented the asset out, you should be cash flowing. The difference between what the rent is and what you're going to have to pay on this now, this £400,000 mortgage, is what the monthly profit is. Very powerful strategy. I've used this successfully a number of times on much larger transactions where at the end you're pulling out hundreds of thousands of pounds and even millions. So that's been pretty cool to do. Something that a lot of people that come to me, they want to do. They want to hold these big chunky assets and rent them out long term, and it's a great thing to do. One of my pieces of advice that I give is not just to focus on that. However, if you come across a deal or if things change and you need to sell, you should sell and cash out and move on to the next one. There's always another deal to be done. But my mistake was that I was too rigid on just that structure. Yes, in a way it's helped me out, and I've got a lot of assets now, and that's fine and it's good. But in another sense, I could have done more deals, cashed out more, be sitting on more cash, rolled that into more deals, blah, 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 blah. It goes on. So that third way I mentioned of retaining the rents on that long-term cash flow, that can be quite powerful for a developer. So you've changed your role from a developer into an investor at that point, but it's still a way to get paid. It's still a way developers get paid. Some developers will do an apartment development, sell a bunch of units, pay back the money they owe, and then wait and hold on the other units, rent those out, cash flow, and then wait for values to increase. And once they're at a level they're happy with, they'll then sell those units on. So that's another smart way to do a mixed approach of selling some, de-risking your position, keeping some assets, say it's an apartment development, and then selling them later on at a bigger profit. Very smart to do. Some developers also price a bunch of units at a lower price to sell quickly, and then they have sort of staged pricing. So once they've sold out of the first batch to de-risk their position in terms of debt and the site, they'll kind of slowly increase prices and charge a premium for the remaining units, so they can make their profit on the back end and de-risk and protect the downside. Very smart way to do it, by the way. But cash flow alone doesn't make you rich. A mixture of holding assets and some decent cash flow helps to really propel your wealth and your business. So it's a very smart way to do it if you can do it. Right, fourth way, pay during the build. So usually what I like to do, or what I have to do, and what every developer should be doing, is a development management fee. Once this project is on the go and up and running, there's a lot of time and resource, if you're doing your job properly, required to run this deal. It requires your effort, my wider team's effort, my investment manager, my head of sales, bookings, administration, finance. It requires a lot of effort and resources from my team. They have to put resources into this deal, and so you've got to be compensated. It not just for it should be a profitable venture at that stage, but cover costs. You're going to find yourself out of pocket, and I've made that mistake where I've tried to get a deal through and I've just removed my fee. Yes, it helped the deal progress, but at the same time, it was a bit of a strain. We should have been paid for the work we did. So these are usually monthly fees throughout the project. It's often a percentage. It can be anywhere from, depending on the size of the project, 0.5% of the construction, what the construction value of the project is. So anywhere from 0.5% to 3%, depending on your arrangement. And it can add up. Obviously, if it's a multi-million-pound deal, you can be getting some. If it's a £10 million deal, and your fee's 3%, that's a £300,000 development management fee over the course of 12 months. It's £25,000 a month. But usually something like that at that scale is probably a bigger project, and it's probably going to be over the course of 2 years. So that'd be £12,500 a month. But again, it's a good fee. It's going to require a lot of resources, but it's a way you should be getting paid as a developer. Your exit and the money you make at the end isn't guaranteed, but at least you have your expenses covered and you can operate. So you run the team, the consultants, you deal with the lender directly as part of the development manager, you deal with the lender drawdowns, that relationship, you deal with the seller, if the seller's still involved as a joint venture. The book stops with you. You may have a guarantee on the line, corporate guarantee or personal guarantee. You've got your money in the deal, or if not just your money, other investors. You've got to protect everyone's position. And so it's a key role. You need to make sure you do it properly. Asset management post-completion is another way to get paid. So once you've done the deal and you've sold it, and let's say your investors own some of the assets still, or you've built the deal and you've sold it on to your investors, or even if you've kept it in-house, your team, even if you've got external managers, property managers running that finished asset, you still need to spend time and resources managing that asset. There's an asset management fee that you can charge. Again, depending on who it is, you can be charged anywhere from 0.5% to 3, 4, 5% in an asset management fee, usually towards the lower end. And you're getting paid for running that asset. Very useful way to get paid post-completion, once the deal's done. That's another way that developers get paid. Waterfalls and promotes. So when you're working with investors, there's different ways that you can work with an investor. A lot of the ways that I work with investors have been they tend to put up most of the funds, if not all of the funds, into the deals that I do, because I'm doing all the work. I've got all the resource, I've got the team, I've got the expertise. I put a lot of the work in. They come in with funds and we work out a fee that they're happy with. So let's say we do a deal where they put £1 million in, and we agree that you're coming in with 50-50 partners, you're going to put £1 million in, you're going to get a preferred return. So you're going to get the first 8% back. So £80,000 a year, you're going to get back first, and then we're going to split the rest and we'll own it together. That's one of the basic structures I use, but it can be done in any other way. It could be, depending on the deal, if it's a very straightforward deal that looks like it's going to go through and there's less risk, then sometimes I don't agree any fee on the preferred equity. So it's the preferred return means basically that money, that £1 million invested, is going to get returned first. If it's a very straightforward vanilla deal, I don't do a preferred return because there's no risk in the deal. There's very little, well, there's very minimal risk in the deal. So that's an important factor to note. So you could just then do a profit split or ownership split. Some deals may be 80-20 owned by the person putting in the money, and you split the rest, or it could be the other way around. Or the money could come in as loan funds. There's so many different ways to structure a JV, and the world is your oyster. So this promote and waterfall is basically on a deal where, say, that investor wants 8% on their money back first. You may agree that, but you also may have another waterfall arrangement whereby once they hit a 10% return, so let's say they get 8% back, and beyond that, you split 50-50 up until there's a 10% return to them. Then you may have an agreement whereby you get a bigger percentage of the profit once they get to, say, 10%, above 10% return on their money. You may agree that you get a bigger profit split in your favor because you've been able to outperform on the deal. So really, you got to be really creative with the structure. There's a lot of structures that are done in real estate like this, and it also applies in the M&A space, in fund management and private equity, where they're really trying to encourage the person running the deal to be tied to the deal and their success be tied to the deal. It's a big thing, 2 and 20. Some criticize 2 and 20 and say that once these funds are at a huge size, if you've got billions under management and your fee to manage is 2%, that's £200 million. If you've got 10 billion of assets under management, and your management fee just to run the deals and look after everything is 2%, that's £200 million a year to operate. That's a lot of money, and a lot of them are making big profits just by the 2% management fee, let alone the performance they may do or not do. Beyond that, they usually have a share of the performance fee. So that can come under criticism. And sometimes the really big firms start reducing their managed fees to make it fair. Overage and uplift clauses. Often in developments, as a developer, if you do a deal and you complete that deal and you sell it on, an overage agreement could be something you have in place where you say to this new buyer that's just bought this finished development from you, you may say, well, I've sold you this deal, there's some land to the side. If you end up building on this land, I'm going to want a share of your future profits, or a share of the future value of that site or that land next door to what you've built. So sometimes developers and landowners do that so they can benefit from additional value, especially if someone comes along as a developer and says, or a buyer and says, look, I know you got the land, I'm not really interested in building on it, I want to buy your asset. You're going to say, fine, you can do that, but if you do build on that land at some point over the next 20 years or 50 years, whatever you agree, I want a share of it. So it's a good way to get paid much further down the line when striking a deal. I've had overage agreements agreed on my deals as well. Sometimes it's like an anti-embarrassment clause. It's effectively somebody doesn't want to do a deal with me, and then I find out that I'm flipping it straight away, making some crazy bucks, and they've kind of missed an opportunity. So they sometimes strike this overage agreement. But I try and stay away from them because it can get quite messy if your deal fails. So let's say you've got this plot of land to decide and the overages relating to that, and then your main deal, you have a deal there. If that fails and it's not as successful, and somehow this side land is going to prop up your deal, I want to be able to make use of that. I don't want to then be stung twice. Not only am I stung on the original site, the main site I was looking at, but I can't even do anything on the next one because I've got this overage agreement. It's a deal killer. So I try and stay away from overage agreements. Obviously, of course, if I'm the seller, I'm going to try and push for it, as naturally who wouldn't. And if I'm the buyer, I'll try and not allow that, because it's really how you're going to get yourself stuck. So, yeah, the overage payments can be triggered by anything. It could be triggered by a sale, planning permission, building work, or a GDV threshold that will be confirmed by a separate value. And there's various ways you can structure this overage agreement. But it can align incentives and reduce the cost you pay up front. You could use that overage agreement that they want to reduce the price that you're paying. Always use every component as another deal to barter and negotiate on. Right, so as a summary, I've given you various ways which you can make money in a deal. You can get it during delivery from the development management fee. It can be at exit, like the house example I gave you, where you can sell it at the end once you've incurred £300,000 worth of costs and made £200,000 profit. It can be a refinance, again like the example I gave you, where you can have a £400,000 refinance, £100,000 taken out because your costs were £300,000, then £100,000 profit. It's a great way to do it, especially if you're doing it at a larger scale. It could always also be long-term income from owning the assets. So some of the apartments that I told you about, you're going to keep it, or even the house you're going to keep. There's some cash flow coming in from that, and you've made money out on day one. Again, perfect arrangement. And then you've got the structure you do, and any overages or any kind of promote you do with future sales of prices. Look, none of this is luck. It's about structure. If you structure your deals correctly, you're onto a winner. Just keep that in mind. There's price is rarely the issue. Rarely the only issue. So property development's not just about construction, it's about value creation. Control, leverage, structure, and that's how developers actually make money from the development.